Today, we're going to be talking specifically about mortgages. We're going to be comparing 2-year versus 5-year deals and giving you the lowdown on which one might save you the most money. Initially, you might think that 5-year deals would be cheaper, but we wanted to actually take a look at this and find out if that really was the case. Hello, welcome back to our channel and podcast. My name is Gemma, and here at WIS we talk about all things money, mortgages and positive money mindset. So if that interests you, be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's podcast of Let's Talk Money and Mortgages, we have Iftikhar co-hosting again. So if you didn't already know, Iftikhar is a trained accountant and mortgage advisor who has been in the industry for over 10 years. He is also one of the founding directors here at WIS Group, so it's an absolute pleasure to have him back on the show today. Hi Iftikhar, how are you doing today?
I'm very well, thank you. How are you, Gemma?
Yes, I'm good, thank you. So it's January, it's the new year. How are things going in the mortgage industry at the moment? Is it still busy?
Yeah, it is busy. It's been busy the last few months. The new 10% products have come out and, first-time buyers have got a chance. So, it's been busy.
And I know that the stamp duty holiday is likely to end soon. Have you noticed like a last-minute rush?
Yeah, there is a last-minute rush because everybody wants to get it done by 31st of March. So, people are rushing to finalize their houses and trying to get the mortgages sorted. So I think we'll see that going on for the next few weeks leading up to 31st of March. So yeah, it is a busy time for the industry.
Yeah, busy time. And we know that for most people, whether they're getting their first house or remortgaging, I think there's always that question of, which would be better, a 2-year or a 5-year fixed term mortgage? So we just kind of wanted to explore that today. And besides the fact that a 5-year term is longer than a 2-year, what are the main differences between the two, Ifti?
Generally on the 5-year deals, what happens is the interest rates are slightly higher. Usually find at least about 0.5% sort of difference between a 5-year deal and a 2-year deal. I'll just take an example. If you take, say, a 500,000 mortgage, 0.5% difference is about 2,500 extra you pay for a year. So what happens is, if you look at it over 2 years, that's £5,000, right? But a lot of people, what they kind of don't realize is that's not the only difference, because what happens is you need to take into account, if you're paying a higher interest rate, after 2 years, the loan outstanding on the 5-year deal is generally more than a 2 years. So if you have to settle the loan on a 5-year deal, you have more money to settle, right? So that needs to be taken into account as well. It's not just the interest, because you got to look at what's left back, right? And of course, the product fee, you got to prorate it. So quite often product fees are something like 999 or £1,000, let's call it. So for that, prorated is £400. So on a 5-year deal, yes, I mean, it sounds good, but you got to take into account all these 3 factors and see the true cost, because true cost is the most important thing. So if you look at it that way, quite often you benefit with a 2-year deal. So what happens is, if you take that into account, you save quite a lot of money. So I tell clients, why don't you take a 2-year deal and pay extra on your mortgage? And that will help you settle your mortgage faster. I think we did a podcast on this earlier as well, 15 strategies on how to settle your mortgage, right? So I think somebody want to have a look at that as well. That might be helpful,
Yeah, so basically if you do a 2-year deal, you will save more money in the long term. That's what you're saying, right?
Yeah, very likely. We have to look at specific circumstances. It can vary from customer to customer. Generally on the bigger loans, people benefit. So always best to talk to your advisor, because advisors will look at your circumstances. Advisors will look at what your future plans, and then they will recommend, right? It's always best to speak to an advisor.
Okay, so looking at that, it seems like maybe a 2-year fixed would be better in the long term than a 5-year. But what about flexibility? Which one of the two seems to offer the most flexibility for people?
I think generally 2-year ones are quite flexible. Just the fact that it's a 2-year deal, right? So, I mean, if somebody told me that there's going to be a virus called COVID after, about 2 years ago, I would have never believed it, right?
Yeah.
You can't say what will happen in the next few years. If you have a shorter term deal, you can easily come out of the mortgage. But if you have a longer term deal, it's a little bit more difficult, right? So 2-year deals in that sense are quite flexible.
So what about, if you had a chance to repay the mortgage early, is there a difference between the deals? Does one
There is, yeah.
There is?
There is, yeah. So usually what happens is on a 2-year deal, banks have on average about a 2% early repayment charge, or ERCs they call it. Some banks have a flat 2% fee, right? So which means at whatever point you break, you got to pay 2%. But on the 5-year deal, it's the other way around, because the flat percentage is generally like 5%, right? So let's say somebody took a 500,000 mortgage, like my example earlier. So he's got to pay 25,000, right? If that's the outstanding balance. But whereas if it's a 2 years, you'll probably have to pay 10,000, right? So there's a massive difference. So that's what I'm saying. It's always important you speak to your advisor. Make sure that your future plans are discussed with your advisor. But saying that, some banks are a little flexible as well now. Every year they reduce 1%. So for example, after the first year, you probably have a penalty of 4%, then it drops to 3, 2, 1, right? But still, if you break a deal in the third year, you got a 3% penalty to pay, right? So obviously, if you lose the 500,000 example, 15,000 pounds, a lot of money, right? So you've got to think about that before you decide.
Yeah, but you made a really good point about making sure that you talk to your mortgage advisor about these things, because I think a lot of people might not realize the kind of importance of just discussing their future plans with their mortgage advisor. They're kind of in the mindset of like, no, I just need this for now. And actually we're saying to people, sure, but in the future, your plans might change, and we could provide you with a product that might not be suitable for you in a year's or 2 years' time. So actually, it's best to talk about those kind of long-term goals, right?
That's right, yeah. I mean, a lot of people come with the pre-notion saying that I need a 5-year deal, right? But I find it for most people, once we discuss all circumstances, they become comfortable that the 2-year deals are generally better.
Does it make a difference with the loan-to-value ratio? People with a higher loan-to-value ratio, like whether they should go on a 2 or 5-year deal?
Yeah, I mean, it's a bit tricky if you're on a higher loan-to-value, which means you have a smaller deposit that you put up front. Let's take, for example, somebody with a 90% loan-to-value. So they got 10% deposit. They are
so that's like
generally
your typical like first-time buyer, right?
First-time buyer, yeah, that's right. So they generally pay the highest interest rate. But just imagine if you go and lock that for 5 years, right? What happens in that 5 years is you start paying your capital back, right? So once you pay your capital back, your loan to value keeps coming down, right? So you have locked yourself for a 90% loan to value product for all 5 years. So yeah, obviously, house prices generally go up as well. So if you look at the house price increase plus, your capital repayment, after 2 years, you might actually be on an 85% loan to value. So why do you really want to lock in a 90% loan to value product when you have that option, right?
What if you're on the opposite scale and you've got a lot of money to put up front? Does then it make a difference? It
could do because sometimes it's good, right? Especially if you look at loan sizes as well. Sometimes loan size matters. So if you're like on a 60% loan to value, that's kind of the level at which interest rates kind of stay stable. So there's nothing much you can go from that point. But again, like I said, you've got to look at your circumstances, right? What's going to happen next, right? Some people move house because children have to go to a different school, different university. Those things you've got to factor, because otherwise you may end up with a situation where you may end up paying that penalty, right? So that's what you have to be a little careful about.
Yeah. And what about if, the economy? How does the economy affect, well, I mean, obviously it affects the interest rates, but, does that mean that you should kind of be mindful of what the economy is doing as you get your mortgage?
Yeah, it's always best looking at what's around you, because you got to look at the wider picture. If you think interest rates are dropping, generally, you don't want to lock yourself to a 5-year deal, because then, you might think, oh, yeah, I'm going to miss out now, right? If the interest rates are expected to go up, you probably want to consider that. But then again, what I find is, if there isn't much of a gap between a 2-year and a 5-year deal, I would reasonably expect the interest rates to kind of remain quite stable, because end of the day, I always tell my clients, banks, they are the winners, right? Because they do more research than any of us, right? So therefore, they wouldn't want to give away a 5-year deal at say 1.5%,
No.
expecting the interest rate to go up to 2%, right? Because you've got to take that also into account.
Okay, so the main things to take away, I guess, is just to make sure that firstly you talk to your mortgage advisor, your mortgage broker on what your circumstances are, so that they know
Mhm.
maybe in the long term if you have
Yeah,
plans that kind of might guide you more towards one product or another. And just,
yeah,
I suppose, to do some research and make sure
yeah.
you know what the economy might be doing. How are we finding during COVID? How is that affecting the interest rates at the moment?
Interest rates are slightly on the higher side, especially on the higher loan to value products. On the sort of low loan to value products, rates aren't too bad. Generally, the remortgage rates are a little bit better than the purchase rates. So banks are a little careful in their lending. So that's why we find that the higher loan to value products are a little bit more expensive.
Okay, well, thank you, Ifti. So make sure, guys, you do your research and you talk to your mortgage advisor. Now, this part of the show, we just wanted to kind of introduce a question time because we've been getting quite a few questions from people, which is really
Yeah.
exciting. We love to help you, so thank you for sending in your questions. The first question, Ifti, that I have is from Amy. She wants to know, if I found another mortgage deal elsewhere, can you match it?
Quite often we can, because we are whole of market, so which means we can deal with any bank, right? So quite often we can. You might be able to do better as well, right? Because it depends on how you look at it. You look at things like true costs for the client and look at various circumstances. So yeah, I mean, I'd like to believe that we can match it or we can do better. So yeah, it's something that you could do.
Okay, thank you. Thanks, Amy. And the next question we have is I'm looking to sell my house before the stamp duty holiday ends. Is there enough time? That's from David.
It's a bit of a tricky one. I think there is enough time, because between now and then we got about 10 weeks to go. So I think there's enough time, but do it ASAP. Remember, solicitors are going to be pushed as well because everybody wants it done before that date. Yes, there's a very good chance that you can get this done, but get on it soon.
And how does it work, Ifti? What if, is it like literally if you haven't completed by that particular day, then literally
Yeah.
the next day after you'll be charged stamp duty?
Unfortunately, that's what it is, right? Unless the
Okay.
government changes their mind, right? We are
hmm
not sure about that, but as of now, there's no announcement, so we have to go with what's there. Yeah.
Right, okay. The next question. Hi, I'm self employed and my fixed rate ends next year, but due to COVID, my books will look pretty bad. What would you recommend for someone in my situation?
I'd say always talk to a broker, because there's always some kind of options, right? Have the conversation now. Don't have a conversation 2 months before your deal ends, because then there's very little options, right? At least this
hmm
way you can start planning, because there might be certain things you can do, right? So, for example,
Okay.
if the self-employed director, maybe if there's reserves from the past, you can take more dividend, right? So there
hmm
are things that you could potentially do so that your self-assessment tax returns look a little better, right? So it's always good to have a conversation with an advisor, because then you can at least start planning, right? But
hmm
there's always some kind of option. There might be restricted options, but I'm always quite positive when it comes to these things. I think there'll be some kind of option available.
Yeah, okay, thank you. Next question we have is I'm thinking of changing my mortgage. Does it cost anything to leave during the fixed term?
Quite often, yes, because there is a early repayment charge. We find some of the variable rates like trackers, some of them don't have early repayment charge, right? But if it's a fix, very likely you're going to have a early repayment charge. So if you're going to come out of your mortgage, there is probably going to be a penalty. It depends
hmm
on what you've signed up for. So each bank has different sort of rules when it comes to these things. So you'll have to look at your document. So yeah, documents, and it will tell you what kind of penalty that you have to pay.
Okay, thank you. And the last question that we have is from Anna, and she says that she's worried that she might lose her job due to COVID. And what should she do regarding her mortgage?
Okay, so if your deal is finishing probably within the next 6 months, it's probably worth having a conversation, but it's always best to talk now so that you can discuss your circumstances. One thing the banks don't like is, if you're losing your job, right? If that's been formally announced, you've got to disclose that to the bank, right? So
Okay.
if it's still, you're just worried, right? Then you probably want to talk to a broker and, potentially try and get a deal or something done because you're not aware, right? If the employers have said, yes, we are going to sort of make you redundant, then, you have to disclose that, and the brokers has to disclose that to the bank as well. So if you're worried, it's always best to sort of, book in a deal early on. So that might be the best thing to do. Yeah.
Okay. Thank you so much for those. So we just wanted to sum up everything. Thank you, Ifti, again for your advice today. And we just wanted to put a reminder out there that these points may or may not be applicable to all borrowers. So please do talk to your advisor if you're unsure about whether these suggestions are suitable for you. And if you don't have a broker, I will leave our WS contact details below because we're always happy to help. Another reminder that a mortgage is secured against your home or property, and it may be repossessed if you do not keep up with the mortgage repayments. Thank you again for joining us today. We'll be back next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.